I'm Ben Huneke, head of Morgan Stanley Investment Management. Big shifts in the markets in the past few months are getting investors to rethink their asset allocations. Joining me is Rui de Figueiredo, Global Head of Investment and Client Solutions and CIO of the Solutions and Multi-Asset Group. Rui, as the head of the Multi-Asset Group, you have a unique perspective, both advising clients individually and also building portfolios yourself. Maybe talk to us about how clients are rethinking how they're allocating their assets these days.
Yeah, I think that investors really understand, as you said, that there are a number of aspects of the global economy, of international politics, of the social landscape that are in transition. And that's creating a great deal of uncertainty and in some cases unease that raise a lot of questions about asset allocation for investors. Some of the questions that they're asking are, what should I be doing with private markets? How do I think about inflation? Should I be globally diversified or should I be doubling down on the United States? And there are a host of issues related to technology and artificial intelligence, which investors need to navigate.
Well, maybe we'll take one of those topics, the U.S. So we're at peak U.S. exceptionalism in terms of the market, but clearly with what's going on in the world, people are rethinking how to allocate to the United States and then how to diversify globally. So how are you advising clients to think about global diversification and risk mitigation?
Yeah, I think it's interesting. I mean, you can think about global diversification both in terms of those 2 points, risk and opportunity. And I would say first, we're not overly negative on the US, particularly the broader market. But that said, we do advocate for investors to be globally diversified. Why? Number one is because diversification does reduce risk. And secondly, because, potentially it's one of the tools to protect investors against, a continued weakness in the dollar. Mm-hmm. That said, we're really thinking about opportunities, and I'll point to 2 sort of key aspects of global diversification to try to create value in portfolios. One is policy beneficiaries. As the world deglobalizes, countries are turning to industrial policy domestically to rebuild manufacturing, and importantly to minimize the dependencies and interdependencies with other countries that could be an issue as the world changes. So these incentive packages are growing to large sizes as a percent of GDP, mm-hmm. and really looking at that to create investment opportunities that we can invest behind. One well-publicized example of that is Germany. They are providing incentives for defense, industrial production, infrastructure, and we're creating investment opportunities behind that kind of spending. Some sectors, right, things like, for example, autos, where the fierce competition with China could actually present more risk. So you have to be very selective in investing behind policy beneficiaries. The other one is AI thematic plays. And we'll talk a little bit about AI maybe later, but one of the key features about AI is that it's been very centralized in a few countries. And as it propagates through the economy, you have to think about where those beneficiaries are going to be. And in many cases, those are outside the US. So as AI becomes more utilized in other countries, other geographies, the downstream effects of those can be invested behind.
So one of the things that's been a focus of your entire career, you've been a pioneer in how to allocate to private markets responsibly inside a portfolio. So what advice are you giving clients now about how to think about the private markets? A lot has been made about the concentration and risk in the public markets. So how is your philosophy around allocating to privates changing?
Yeah, I think that, look, fundamentally, private markets are here to stay, right? And they're becoming much more broadly available for investors, which means that, investors need to think about how do I integrate private markets into the portfolio. And as they do that, typically with investors that have invested in just more liquid markets, have basically tried to generate returns in 2 ways, basically by following the market, which basically follows the economy, and other aspects of policy. And then secondly, investing actively, right, with organizations to try to add value through stock selection, for example, or, in fixed income. When you introduce private markets, you also introduce the issue of illiquidity. And that is something that investors have to think about carefully, right? They get benefits from investing in private markets, both in terms of diversification and return enhancement. But the major factors they have to think about are, number one, diversification. There are lots of different kinds of private markets. There's real estate, private equity, private credit, infrastructure, and generally a more broad approach rather than just selecting one of those categories can lead to a much more efficient portfolio. The second, you need access to the best right? Individuals and organizations being able to pick the strongest private market managers to be invested with in advance. The third is being in the right place in the right time, right? So there's a host of strategies, a host of opportunities in the private markets, and being able to navigate that is a crucial factor that we, in our portfolios and with our clients, we try to advise on. And the final one is what I mentioned before, was liquidity. When you're investing in private markets, over the long run, you should get paid for giving up the opportunity to trade in and out of your assets. And that so-called liquidity premium is very valuable in a portfolio. But it comes at some cost, right? You can't trade out of your portfolio. You can't rebalance your portfolio. You can't respond to unforeseen cash flow requirements. And being able to understand how much of that liquidity premium you can take advantage of is a very client or investor specific question and requires a customized approach to determining how much of private markets you can take in your portfolio.
I mean, you referenced that the private markets are changing. If you went back 10, 20, 30 years, largely an institutional marketplace, largely big, sophisticated institutions investing in private markets. A lot has been made of the democratization of private markets. How are you talking to clients about changes that democratization will take in terms of return expectations, maybe increased liquidity, or how is the private market changed by the influx of capital from wealth markets around the world?
This is a very, very important trend in private markets. And you're right, there are a couple of important points to this. Number one is it opens up a whole new opportunity set for a new set of investors, which also brings more capital with it. So that's one point. The second is that there's innovation, as you referred to, Ben, in how investors are accessing it. So traditionally with closed-end vehicles that lasted for a certain amount of time that you were committed to and then you got the capital back, it's not the model necessarily anymore. We've seen the emergence of what people call evergreen, permanent, invested vehicles that also provide liquidity. And that's a very different sort of type of vehicle to access the private markets than what we've seen traditionally. So what are the implications of that? I would point to two things. Number one is, on the first point, is more capital maybe it has an impact on returns like you're referring to. And I think in general, when there's more capital in an area, it should have an effect on returns. But I think what we're seeing is that that's not true uniformly across the private markets. That capital is coming in primarily at the top of the funnel in large companies with large funds. And that means not only, that potentially there will be more capital in those spaces, but also there'll be more buyers for smaller companies and smaller funds. And so that the emergence of this growth in the democratization of private markets will actually lead to more opportunities and potentially even higher returns, but in the smaller and mid-market parts of the private markets, which really means that that's where investors should be focused. The second point I raise is that, how are investors going to use these various formats, the traditional closed-end funds versus the open-end funds? And I think the answer is, many people are thinking, partly because there's so much focus on the semi-liquid evergreen funds, that investors will choose one or the other. And I think in practice, what we'll see over time is that they'll be seen as complements, not substitutes. They're not going to generate the exact same performance. They don't have the exact same types of investments inside. And so investors will probably use both, right? Part of their portfolio will be in semi-liquid and part of the portfolio will be in more traditional.
And do you see that happening both on the retail side and the institutional?
Very much so. I think right now what we're seeing is that most of the retail investors are almost exclusively going into the evergreen and semi-liquid products. But that's because it's a new opportunity to get in. I think over time what you'll see is the institutional investors will start to use semi-liquid products as a tool. We haven't seen that yet in very large degree. And you'll also see the retail investors, and not all retail investors, but a subset of the retail investors, use different parts of the private markets, the more liquid and less liquid, as different parts of their portfolio.
Great. Well, maybe pivoting away from private markets to another really timely topic, inflation. So the Fed has a difficult road to hoe here in terms of finding the right balance of inflation versus the labor market. What are you seeing in inflation? What are your expectations about where we go from here?
One of the interesting things, particularly in the developed markets, is that until 2022, most of us, for most of our careers, and most individuals hadn't experienced inflation in a very serious way. And so I think a lot of investors, when they're constructing portfolios, had kind of forgotten about the discipline of having some protection against inflation, which can be very negatively impactful to spending power in portfolios. When we got to 2022, and then when we look beyond, right, it's a new world. And I do think because of, our view is, various policy actions, what's happening with growth, you mentioned the labor market, that we are likely to see inflation persist at a much higher level than we saw prior to, the previous 30 years. Not necessarily like 2022, but at a higher kind of steady state level than we have in the past. Now, the implication for that is that investors, and I think that this is the lesson of 2022, need to have an appropriate set of so-called real assets. It can be tips, commodities, certainly real estate, infrastructure in their portfolios that gives them some protection against sort of spikes in inflation, particularly ones that are unforeseen.
So maybe another topic that you mentioned at the onset is AI and technology. The numbers around some of these projects, around these data centers, are shockingly large. What are you talking to investors about how to invest in this incredible burgeoning technology?
This is a topic that can be pursued in many, many different ways, but I'll point to sort of two kind of things that we're focused on. One I referred to earlier, which is, most of the AI emphasis in the markets has been in the so-called Mag 7. I mean, that's really where we've seen sort of, and really when you think about it, it's been at the first order layer of AI, right? Really the infrastructure, semiconductors, data centers, power utilities. Two implications, I think, as we go forward, right? The most important thing, I think, in thinking about AI in portfolios is thinking 2 or 3 layers down the tree, right? What's the next step, not just what's the current one. And I think that in one case, right, what we see is, or what we expect, is that there will be a broadening of that concentration in the market. And as we get more breadth, the opportunity, it's been very difficult, for example, for active management, for people that are picking stocks, because it's been so narrow in the market with just 7 companies really driving it, that as the market broadens out, we'll see a return to active management actually paying off. So that's one area where we're really shifting our focus from just playing the market to being much more focused on security selection, stock pickers, and so on. The second one is what happens after we get past the infrastructure layer. And there are going to be multiple sort of dominoes to fall, but we think the next ones are what we might be thinking of as the digital adopters, things like platform software and services, and the physical adopters, things like autonomous vehicles, humanoids, defense applications where AI interacts with the physical world. And so really, as we move to those next layers, right, it's not as obvious who the winners and losers are going to be. And so again, I think that one of the, even within the sort of AI waterfall, what you're going to see is a lot more differentiation, which means that, skillful stock selection in those next generation layers, where the market is going rather than where it's been, is really going to be the key to success.
So maybe one more personal question while we have you. Where do you look for inspiration on a personal level?
Outside of my work and my family, probably the most inspiring thing that I've done in the last several years has been mentoring a high school robotics team. I'm a mentor for one of the sub-teams on a relatively large team where we live, and honestly, mostly as an observer. The kids really drive the agenda and the execution, and watching them ideate and then bring their ideas to fruition is actually remarkable. It gives you hope and inspiration about the next generation. When you see these kids so self-motivated and capable to take something from a whiteboard or from a screen to actually a physical functioning robot that performs well and out there in the world. It's just been amazing.
Well, it's like building robots is going to be a growth industry.
Yeah, that's true. Yeah.
Well, Rui, thank you so much for being here.
Thank you.
Don't forget to check out more asset allocation insights from Rui and the Portfolio Solutions Group. Visit morganstanley.com for more on multi-asset investing, and be sure to subscribe to stay up to date on our latest investment ideas.